Hey, good morning, everybody. For those of you across the country and kind of in some of this environmental craziness we got going on, I hope you're all safe. You know, the fires in California and the cold, freezing weather in the southeast and kind of across the Midwest. I hope everybody's safe and families are healthy. So I just wanted to welcome you, everybody, to the new year. Hello, everybody. My name is Felix McGowan, Director of Ameren Critical Infrastructure. We are a group inside of Ameren that provides grant writing, project management, and IT services to tribes. Today, I'm excited to introduce our first trusted voices for the year of 2025. We are talking about how insurance companies work financially. To share this information, joining us is Kurt Mora. Kurt is a citizen of the Jemez Pueblo and is an accountant for the financial team at Ameren. Welcome, Kurt. The floor is yours.
Thank you. Just quick mic check. Can you hear me, Felix? All right, awesome. Thank you, Felix, for the introduction. Good morning, everyone. My name is Kurt Mora. Again, I work with Ameren. I work in the finance department. I am one of the accountants. And I will be going over the financial cycle of the insurance industry. It'll just be a high level overview look of what kind of the cycle looks like, just to give like I said, a high level view, and just to give you an idea of what to look for, items to consider as you or potentially your clients that you might serve are looking for insurance coverage. So hopefully this will help you understand a little bit of the financial cycle of how things work, other than you have insurance, you have coverage, but we all pay premiums. So this will help understand where those premiums kind of go, how they kind of are utilized by the insurance companies or the carriers. So this will provide that for you all. So again, welcome and thank you for joining us. So just a little bit about myself. I am from Jemez Pueblo, New Mexico. It is one of the 19 pueblos here in the state of New Mexico. Our Pueblo reservation is located northwest of Albuquerque, going towards Cuba, New Mexico, or the Four Corners, Farmington area, going towards that direction. It doesn't reach that far, but that's where our reservation is located. So if you're ever in New Mexico, feel free to come and visit our Pueblo, our valley that we have. There's a lot of beautiful views, drives up you can take. Another fact about me is I am fluent in my native Towa language. I gave a brief introduction, a greeting just a while ago. I have a bachelor's in accounting that I received from New Mexico State University in 2013. I also have a master's in business administration, also received it from New Mexico State University in 2015. I have worked at Ameren since 2015 in the finance department, and I have two amazing boys. I'm a father of two boys, Marcos, who is 6, soon to be 7, and Emiliano, who just turned 2 years old. So very fun time. They're growing well and healthy, so I plan to be as active as I can be with my fiance, with both of them. So that's just a little bit about me, and there's my photo there if you ever need to refer me for anything. A brief introduction about the presentation for today. Again, we'll learn how insurance companies handle premiums on a high level. We'll also talk about claims, how those are assessed and issued out to our insureds. We'll talk about revenue reporting. We'll also go over a policy from inception, or basically what that inception means is the start at the beginning of the policy to how it translates and finishes onto the financial statements, and how those statements are assessed utilize or assessing the strength of the carrier or the insurance company using those financial statement information. So a couple of assumptions to be made while going through this presentation. Assume that the policies have already been created, quoted, and issued by the underwriting team. So all of that front legwork has already been done. So these examples, again, you can assume that that's already all been completed. And we're just going through how a policy is activated. Another assumption, assume that the individuals, the insureds, are paying their premiums on time. So when premiums are paid on time or in full, this example is much more simpler and easier to see. And if premiums aren't paid, then it kind of changes up the format or the timeline of the policy. However, let's remember these two assumptions while going through our examples. So we need to ask ourselves, why is it important to know financial information? So there are a lot of benefits of understanding financial information, right? So it just depends on the carrier and the industry that you are working in or that you are working for. So what does that mean for the department or the company? But in terms of what we'll be going over, it'll be helpful to understand a financial cycle of insurance that can ensure insurance coverage of property. So we'll understand how coverage is made by way of financial transactions. The second bullet, it's helpful to understand insurance financial data that can help you make sound decisions as an insured or as a stakeholder. So whether you're searching for private insurance for whether it be your home, your auto, or whatever coverage you're seeking, understanding their financial data will help you gauge what carrier or company might be in a better financial standing. Or as a stakeholder, you're looking to invest or potentially partner with somebody or an insurance company or a carrier. So understanding financial information will help you know that the company is in good, stable condition. The third bullet, understanding the financial strength of an insurance company can help determine which insurance company is the best option. Kind of a good transition from the second bullet. So like I was saying, it'll help you gauge what the strength of the company is and the standing that they are in, whether or not they can sustain a long-term partnership, or if it's a company that you want to maintain relations with, or just be an insured with that company. So if their financial state information isn't looking too well, more than likely their future isn't that promising, right? So kind of just helps you understand overall knowing financial information, all of these things that can factor into making a decision, not only for the certain time and point, but also in the future as well. So here's just a brief outline of what we'll actually be covering during the presentation. So first, we'll start with a basic life cycle of a policy. How does it begin and how does it end? Followed by the financial transactions of insurance companies between the insured and the insured carrier, the receivables, the claims and expenses, what those look like. We'll also cover again the revenue cycle. We literally earn your business through the financial statement process that takes place. And we'll go over that just to highlight what that really means. And a little bit of financial insight, kind of just look at some financial statement examples. And then finally, we'll look at the financial statement insurance ratios that a lot of companies are assessed by external companies or insureds or whoever partnerships that are looking to engage with insurance companies, there are 3 ratios that we'll be covering that are most insurance carriers look for dominantly. So we'll be looking at what those are. So to continue with the first bullet, the life cycle of a policy here. So here's like I said, a really simple example. Typically, policy terms last one calendar year. Whether that could be this example here shows the start date of this policy or the inception date of this policy is January 1st. The end date of this policy is December 31st. So like I said, these can be calendar year. They're typically 1-year terms, but they could also have different start times. So a policy could start April 1st and end March 31st, start July 1st and end June 30th, or October 1st and September 30th. So those are typically the start and end times of policies, whether it all depends on, or I should say, those are most kind of applicable to commercial coverages. Now, individual coverage, home coverage, or individual policies will have so many various different start times and end times based on when the insured reaches out to the carrier and wants coverage. So those will fluctuate and have a little bit more different start and end dates. But for our example, we're using a very simple start and end date. There are short-term policies that carriers will also offer. Most insurance carriers will need to be negotiated or discussed or arranged or agreed upon to have short-term coverage. Now, sometimes those take place so that you want to have a certain start time that you want to start in, and maybe you're kind of leading up to that target date that you want, and they'll offer a short-term policy so that you have a renewal of the start date that you want. That's typically the reason why those are granted. There are also long-term policies that are more than a year. Again, those are also have to be negotiated, agreed upon by the carrier and the insured, and kind of have a purpose to do so. So what activates the policy? That's the question that we'll be answering on this next slide. So really what activates the policy is money. So other than the time that actually has to lapse, there has to be monies received at the insurance carrier in order for your policy to actually activate or have coverage. So what that means is the premium amounts, the premiums that we pay are what the insurance carriers charge the insureds or charge us. And what they call those are premiums. And that is the amount that you pay for insurance coverage. Typically, payment is due prior to the effective date, which is mostly preferred by insurance carriers, so that the insurance carrier already has money and they know that they are obligated to have that coverage, which they still will. There's also a grace period of 15 days after the policy effective date that you can pay. However, if you don't pay within that 15 days, your policy will cancel. Or if you are on a payment plan, if you don't pay any of those payment plan due dates, your policy will also go into cancellation. Any type of premium payment that is made to the insurance company or carrier will create equity. So basically, you're paying for the time of the coverage that you're wanting. You're basically paying for. So for easy example, if you pay your full premium that you owe, if you pay it in full, you essentially have coverage for the entire time that your term states. So that could be a year, however long that you have coverage for that is agreed. If you pay in full, you're already basically covered for that full amount of time. If you're on an installment plan, you're basically essentially paying coverage for chunks of time as time goes on. So if you're on a 4-pay, you're paying for the 1/4 of the time of the term that you have covered, and next payment is the same thing, go on, so on and so forth. So it's important to pay your premiums, otherwise your carrier will cancel your policy because there is no payment. So typically, insurance carriers will offer payment plan options. The annual payment or pay in full is the option that most carriers would prefer because all the payment has been received and there's really no collecting and billing that needs to be done. However, that's not how everyone operates. So payment plans are also offered, and those you need to see your carrier or your insurance company to negotiate that. And as I was saying, once a policy is paid in full, whether if you have a full pay or a payment plan, once your payment is paid in full, the policy is now allowed to go through the duration of its coverage term. Well, it will reach its end and start a new term, and it will go into renewal. So at that time, you can either renew with the same carrier or you can seek out other insurance carriers if that's what you feel that is necessary to be done. So at that point, you can wait until the end of the term, or you don't have to wait until the term has ended. You can seek coverage elsewhere if it's a dire need that you need to switch carriers. So to answer the question, essentially, like I was saying, just to wrap this up real quick, what activates the policy, one is paying your premium. The second way that your policy activates is time. So as the example that we're using now, the start date of the policy was January 1st. So now if you look at the date and time that we're in right now, it's January 23rd. So if payment has been made on that policy is now effective because January 1st has already happened and you've already paid. So that is what activates a policy and keeps it active. So that's money coming into the insurance company. And we're in the business for covering property or whatever it may be that the insurance carrier is covering. We're in the business to pay a claim if a claim is submitted by the insured, and that is the reason why we are in the business. So claim payments are issued when there is a loss reported within the policy coverage term, which is a very important. The loss has to incur within their coverage term. It can't be something that happened outside of the coverage term, either before or after. And those guidelines are written in their agreements between the insured and the insurance carrier. So claim losses reported are assessed by a claims team. Once a claim is deemed eligible per your policy terms and your policy is in good standing with premium payments that you're paying on time, the claim can be processed and paid out. So there are times when a premium is not paid and there's a claim submitted. If the policy is late for payment or past due, the insurance carrier will not consider paying that claim unless the premium that is owed is paid, because essentially they need to get their premiums paid out before we can pay them back for the coverage that we're giving them. So that's also important to know and understand that the amount of money that you pay essentially ensures that your claims will be covered and there will be no other issues that you might be running into. So here are just some examples, of some claims, losses that are paid. So the first four are primarily property claims that can affect a property. So examples are fire, windstorm or hail, water damage, or vandalism. Another example could be a liability coverage. So if somebody goes and God forbid hurts somebody or does something while they're on the job and there's a third party involved, there can be a lot of liability, a lot of court that needs to be had, and cases to be open to resolve those claims, which are very long, can take years to settle. However, some of the other examples are much more easily assessed, visible, determinable, and are kind of, tangible. So depending on, again, your policy terms and coverage, some of these might be excluded. You have to ensure that the losses that you're submitting are covered, or make sure that they are not excluded. And if they are excluded, you can work with the carrier to try to include them in your policy. However, that might bring on more premiums that you might owe on your policy. So just keep that in mind. Make sure that you're covered for items, major items that you do want covered, and other smaller items that you might consider as a possibility of losing your property. So those are just some examples. So going on to the next portion of the presentation, earlier I had stated we earn your business. So this is going and looking into the revenue cycle. So just to kind of recap, so we looked at how a policy is structured. It has a 1-year term, how it activates, how it starts, and throughout the duration of the policy term, you're paying on coverage, or there could be claims that are submitted and paid. And as time goes on as well, within that same coverage time, the insurance carrier or company is essentially earning your business. So revenue recognition of insurance premiums in the bullet here. Premiums are recognized as revenue over the coverage period of the policy. Unearned premiums represent the portion that have not yet been earned and must be deferred to future periods. So just to give an example and put numbers to this policy, using the same policy term time, 1 year, January 1st to December 31st, this policy has a premium of $24,000 as an example. So if as an example, when March 31st, or if there's time has lapsed through March 31st, the insurance carrier or company will earn and recognize $6,000 of the total $24,000 in premium as earned, which is essentially 3 months worth of coverage. So if you divide the 24,000 by 12, that's $2,000 earned per month. So if you look at it as of March 31st, the first quarter, $6,000 of that has earned on the insurance carrier's books, and they recognize the remaining portion, $18,000, as unearned premium, the 9 months that essentially has not yet lapsed. So further giving this example on this next slide, as time goes on, if you look at this from the top down, if the time reaches to June 30th, or the date reaches to June 30th, we would then have earned half of that $24,000 of premium, $12,000 of earned premium, or 6 months, and still have $12,000 of unearned premium, which is essentially the second half, the 6 months that is still not yet lapsed. And in the middle example, if time has lapsed through this September 30th, $18,000 of the $24,000 essentially is now recognized as earned revenue on the books. $6,000 remains as unearned revenue for the last 3 months that have not yet lapsed. The bottom example, if the full year has lapsed and has happened, now the insurance company can recognize $24,000 of the full premium as earned revenue since that full policy term has lapsed and gone through its cycle. So that is how insurance companies essentially literally earn your business as far as revenue goes on their books, on their financial statements, on their profit and loss statements. So the earned portion you'll see and recognize on the profit and loss statement. The unearned portion you'll see easily more identifiable on the balance sheet. However, there's a way you can see it on the profit and loss statement as well. So just to give an example of how companies recognize these are typically done in 1 month segments. However, just as easier example's sake, I broke this down into quarters. So that is how revenue is recognized over time, over each policy term. This is just one policy as an example. If the carrier has multiple policies, each policy has basically their own timer of when to start and end the earned and unearned portions of each policy. So it can get very convoluted with so much data, timers that are going on, policy terms. The amounts can vary, and all such different factors that play a role if policies cancel and such and things like that can affect these things. So as far as the revenue cycle, this is the example that I want to provide you all. So here are some financial statement examples of if you were looking at an insurance carrier financial statements. On the left side are the examples for the profit and loss statement or the income statement. On the right side, you have the balance sheet. So most insurance carriers will have written premium. If you look at on the left example, written premium is your gross premium. Ceded premium is anything that the insurance carrier has reinsurance coverage for. Basically, the insurance carrier also has insurance coverage from a larger company, and we cede off those premiums. If you net all that out, it's net written premium. The change in unearned premium. So here's the part that I was talking about, the unearned portion of policy amounts. The amounts that change, as you saw in the example, the unearned amount decreases as time goes on. So if you look at the change in unearned premium, that number is always essentially coming down lesser and lesser. So, but it's not always going to go down to zero because, like I said, different policies have different start and end times. So if you look at one insurance company, they essentially have unearned premiums every day of the year because some are ending, some are starting, and you just have a mix of those. So that is where you can see the change of how unearned premium has decreased or increased if there's new policies that have been issued. So if you take the net written premium minus the change in unearned premium, it gives you the net earned premium. So that is the net earned premium is essentially what it's called, and the revenue that is earned for that specific time period at that point in time on the profit and loss statement and the income statement. Below that, there will be, so those are your revenues. So below that, you'll have your expenses. First part of the expenses are always typically going to be your losses. The losses are the claims essentially that are submitted. These are actually going to be claims that are paid, have been paid, or are due payable to the insured. So that is what will be covered in this section, the loss and loss adjustment expense activity. The total of those you can find for that certain time period is what the total losses that the carrier is recognizing as claims paid. Below that, you will have your operating expenses. So The first line of it, the expense that the carrier itself incurs are the policy acquisition costs. So everything that happens before a policy is issued. So whether that's networking, trying to bring in new business, trying to retain business, all the underwriting work that is completed, that the underwriters have to basically build your policy, quote it, all of that front legwork that happens, those are acquisition costs, followed by the overhead costs or the indirect costs, the supporting costs that the insurance carrier may have. That can be your somebody like me in our department, or finance, IT, or whatever it is that is indirectly not or not essentially part of the policy portion of the expenses. However, we are here to do everything else that is needed for the company. If you take those operating expenses, that is going to be your total. So both the total loss and the total operating expense are going to be your total loss or total expenses on the financial statement profit and loss. Now, if you look over on the right side of the balance sheet, typically all the assets are listed on the balance sheet first, and whatever assets that the insurance carrier has is what they'll show. This example, they have a few here, current assets, but there can be long-term assets or whatever else that the carrier might include. All the assets are typically on the top. Liabilities are at the bottom. So your liabilities can include losses that are still deemed to be paid that are payable. Also losses that the insurance carrier expects to be reported based on maybe it's a large weather event like a hurricane or a tornado or whatever may have happened that the carrier is anticipating to be reported but not yet reported, is also what they show. In the liability section, you'll also see the unearned premium. That is the premium that has not earned on a policy. In the slides before, those were the numbers that were in red. So of all the premiums or all the policies that are in effect at a carrier, the total unearned amount is this is where you'll find it, that are yet to be earned, that will then translate into the profit and loss statement as earned premium as time goes on. So these are just some examples of financial statements that you might see on an insurance carrier books or audited financial statements, and what you can look for and what those numbers mean. So lastly, we'll go over some financial ratios that insurance carriers look at primarily. The first is the loss ratio. The loss ratio represents the percentage between total premiums earned and the actual losses incurred over a given period of time. The next is the expense ratio. It represents the percentage of premium that is used to pay the cost of acquiring, writing, and servicing insurance and reinsurance. So loss ratio, again, if you think about that profit and loss example that I gave, it's that first under expenses is that loss section. The expense ratio uses that second portion of the expense section where it has all the incurred costs by the company. The last ratio that they look at is the combined ratio. It represents the combination of the loss ratio and the expense ratio, thus the name that it gives. It combines the loss and the expense ratio. It provides the profitability of an insurance company and how it is managing its risks. So that is how the combined ratio can be viewed as. So here are some examples. And here's the definition once more on top. The calculation is loss or claims paid plus loss adjustment expenses divided by your premiums earned times 100. So if we use that policy as an example, the $24,000 premium policy example, for example's sake, say there were $13,000 of claims that were paid on that policy. So if you use that total and do the calculation, the loss ratio for that policy is at a 54.17%. So what we're striving for is anything that is below 100% on all of these loss ratios, the loss ratio, the expense ratio, and the combined ratio. We're shooting for anything below 100%. So as an example for the expense ratio, the definition is up there on top again. The calculation of the ratio is the acquisition and operating expenses divided by your premiums earned times 100. So say, for example, that policy, the $24,000 policy example, had incurred $4,000 of expenses. You calculate that and it gives you a 16.67% expense ratio. Again, we're striving for anything less than 100% on any of these. Lastly, the combined ratio example. The definition is there again for your viewing and reading. The calculation is the incurred losses plus the operating expenses divided by your premiums earned times 100. Or you can simply add the loss ratio percentage, add it with the expense ratio percentage, and you get your combined ratio total. So here, using this example again, if we take the loss ratio from the previous slide, 54% plus 16% of the expense ratio, it gives you a total combined ratio of 70.84% or 71%. So the companies are always looking to have all of these percentages below 100%. And what that means is for every dollar that we receive and collect in premiums, we're spending less of that dollar to pay out our losses or claims and our expenses, and the remaining portion of that can be considered as profits. So if there's a company that is experiencing that the percentages are above 100%, it means that for every dollar they receive, they're spending an additional 1 cent, 2 cents, 10 cents of profits that they should have been retaining, that they're now at a loss. So again, if you're looking at financial statements, examples, you can calculate these using these ratios. I mean, the calculations that are provided, or the insurance company might provide them themselves. So I wanted to provide those examples for you all, and basically how the policy starts, and on the financial side, how it is reported and how we assess the strength of the company using those numbers. So that concludes my presentation for this morning today. Does anyone have any questions? And I have provided my contact information here. Again, my name is Kurt Mora. I work in the finance department here at Emeren, and I am one of the accountants. So feel free to reach out if you have any need to do so. Thank you.
Hey, Kurt, thanks so much. That was great. Lots of really great information. Really enjoyed it. We had a couple of questions in the chat while you were talking. Some folks were wondering about the examples of losses that you were using, and whether or not they apply to all policies. And I just explained that everybody's got to read their policy and see what is actually covered under it. So these are just broad examples and not necessarily to be taken as everybody's policy covers all of these things in your example.
Yeah, exactly. Yeah. So like just as Monica stated, you have to see what your policy deems as covered, whether that is, if it covers any of these. Again, the page that you might want to be interested in is what the exclusions are. That means what the policy excludes coverage for. So if any one of these are listed on the exclusions, it means it's not covered.
And we had a question about, as we usually do, will we share these slides? I always send an email afterwards with a link where you can download the slides if you want to take a look at them. Of course, always feel free to contact any of us here at Amerant, and we'll answer your questions regarding this information. I have to admit, when I first learned about these loss and combined ratio and stuff like, it took me a minute to figure it out. But I think it's really cool that that Kurt, you explained it a little bit more, like, why would we need to know something so complicated? And so, do you want to talk a little bit more about like being an informed insurance customer?
Yeah, I mean, I think you know, I think having the financial understanding helps you as an insured understand that the company that you're buying coverage from can be there for a long period of time, or like, you know, a long time in the future, right? That they can sustain themselves, that they're in good financial standing. Um, you know, there potentially might not be any coverages that you had covered before that they're no longer covering, because that can happen. So there are just many factors of shopping around and knowing the financial information of the insurance company to help you determine help you make that decision. There are other factors as well, you know, the history of the company, maybe where the company is headed, or if there's any legal battles the company might be in that might deter their future um, outlook. You know, so many other factors that you have to consider to make a decision. But if you want to just look at purely just financial information and the history of it, then this will help you determine if they have been on a good track, or if they're truly just a volatile, you know,
Right.
carrier. I mean, we just don't know. That's the other part. You know, a lot of the unknown is the weather, right? So whether it's a you have to account for if they had a bad year, there were just so many storms, or maybe it was a year there were not really many storms. There's just so many factors that play in. But however, how do they really weather the storm? No pun intended, right? So can
Right.
they, you know, can they sustain themselves? So, but yeah.
And for me, I think it's also a big decision when choosing an insurance company as Native people. Is this the only Native-owned insurance company in the United States? Correct, it is. We are the only one. And if that's important to you, that also can go into your consideration of whether or not you want to choose Amerind as your insurance company. Well, Kurt, thank you so much for sharing this information with us today. We really appreciate it. And like I said, anyone who's attended, I will be sending an email out in just a bit. And we will definitely get that information out to you. And Jocelyn, I see you have a question in there, and we will, I'll have somebody from underwriting contact you and answer that question about the fires in the LA area. All right. Well, thank you all so much for joining, and stay tuned. We are going to have a lot more of these this year, and we'll send you emails and information about upcoming Trusted Voices webinar. Thanks, everyone.
Thank you.